it's really, really important that, when you're thinking about acquiring assets, that you've got to think that sort of, what's this asset going to be like in 5 years' time and 10 years' time? How could the market conditions change within that catchment?
Welcome back to Property Perspectives. I'm Ashley Toy. I'll be your host for this series alongside Tom Sharman, our Head of Research and Strategy. This series will be going through the main sectors in real estate, and today we are starting with retail. And I'm really pleased today to be joined by Allan Lockhart, CEO of NewRiver. NewRiver are a leading listed REIT specialising in resilient retail across the UK. I hope I've got that right.
Yeah, thank you very much.
Your website,
yeah, we like to think of ourselves as a leading retail REIT. Yeah, but
Good.
Thank you.
So Allan, thank you for joining us today.
Pleasure.
If I could start, I'll give a brief CV. You can correct me if I'm wrong. You started your career back in 1988 with Strutt and Parker.
A long time ago.
Yeah, I wasn't going to make any comment on the time, but you've seen a few cycles. I think it's probably fair to say.
Definitely, I've been through growth periods and recessionary periods, and it's been quite a journey for sure since 1988.
Yeah, and
good journey overall. Yeah.
In 2002, you were retail director for Hallidale PLC.
Yeah.
With a remit to acquire value-add opportunities across the retail space.
That's correct. Yeah.
And following their successful sale in 2007, another ominous time in the cycle, I guess, you co-founded NewRiver, where you served as property director.
Correct.
Following their IPO in 2009, until being appointed CEO in 2018.
Correct.
So,
yeah.
I guess it would be helpful just to start and reflect on your time at NewRiver. I guess we've talked about cycles in there. There's a couple of things that have happened specifically in the retail sector. So yeah, just interested to get your reflections.
Yeah, I mean we IPO'd NewRiver in 2009. At the time, there was just literally two of us. We didn't even have a CFO. We had no assets, but we had experience operating in the public equity markets. Hallidale was a business that was floated in 2001, and then we engineered the sale of that in the first quarter of 2007, and for our shareholders that had been on that journey with us, we delivered a 31% per annum compound return. So we had that track record, and so we felt there was the option to list NewRiver directly onto the UK stock market was available to us. Notwithstanding, it was a very, very challenging and difficult time back in 2009. We wanted to be a sector specialist because we believed that was the direction that listed real estate was going to go, more sector specialization. And retail was a sector where we had a lot of expertise and experience on. Plus, it's a very dynamic sector, always changing, and we think that plays well into an active asset manager. And then finally, we recognise the importance of income returns as a key component in a total return, and so we wanted to be very much a sort of like an income focused type REIT. So really, from 2009, we raised a small amount of capital, got the show on the road, and we started to sort of build up NewRiver from that perspective. First 2 to 3 years were really challenging, coming out of the great financial crisis. I think it was probably fair to say that we felt there was going to be a greater buying opportunity quite quickly, partly to do with a lot of the sort of distressed lending and loans that had happened during the sort of run up to the financial crisis. But it actually took quite a few years for that opportunity to sort of emerge into the market. Really, from about 2012 onwards, we were able to start to accelerate our growth. We were able to fund our growth with the support of the public equity markets by raising capital. So we had a good sort of growth period, and then we've also had challenges that we've had to sort of overcome. Obviously, COVID was an incredibly challenging time, particularly for us as a business, being very much a consumer-facing business where a lot of your tenants were forced to close. But also we could start to see how technology was also disrupting, our marketplace, with, online retailing. And of course, the internet's been around a very long time, but it was the convergence of a number of technological advances coming together at the same time. So much faster broadband speed, the explosion in smart mobile phone technology, the massive growth of the big social media platforms, which are in many ways are out and out selling platforms. All of that sort of converged, from, I would say, 2012, onwards, and it started to really have an impact when more of consumer spending went onto the online channel. And, ultimately that had an impact on the demand for space, and of course, supply remaining pretty fixed. Markets got into an imbalance position between supply and demand, and in any market where you have an imbalance, it usually leads to sort of challenges and negative outcomes, and we've seen that in the retail market. So, we've had to come through that and come through COVID, which we did, and we think we got through that actually in a pretty good way. We weren't immune to it, but and we had some challenges that we had to deal with, but we came out of it, and we arguably were, from about 22 onwards, probably in a much stronger position than we had been for quite some time, with a lot of cash in the bank, and waiting for the right opportunities for us to be able to deploy that to deliver the sort of outcomes that we wanted to for our shareholders. And that then led us into doing our first public M&A deal back in 2024, when we acquired Capital Regional PLC, and that was in many ways a perfect transaction for us because their portfolio was very much aligned to our portfolio. It provided us with greater scale within our business because our gross assets and net assets went up something like 60% and 30%, and it was a very earnings accretive transaction because we were able to absorb their 6 shopping centres onto our platform with very minimal costs. So we were able to strip out a lot of cost out of that business, which went straight on to the bottom line, increasing our profits and therefore delivering strong earnings per share growth for our shareholders. So. And today, we completed that transaction, December 24. We've been delivering those benefits. We feel our business is in a really good place today. We think our marketplace is probably in the best position it's been for about 10 years. So we're pretty optimistic around the future. I think there are some wider sort of macro challenges around the UK. There's some challenges around the UK stock market at the moment because we're a relatively small company, and scale within the public markets is becoming more important. But I think the government's aware of that, and they're looking at ways that they can try and improve sentiment within the UK stock market, and we'll see what happens.
Your focus on convenience retail, largely, is that something that happened kind of organically? Was that something you always was a key part of your strategy?
It was always a key part of our strategy. We've never, for example, had department stores in our portfolio, and that's always been very deliberate because we felt that department stores and being overexposed into fashion, you were going to be more vulnerable from the growth of online retailing. And that is clearly happened, and therefore investors that own buildings let to Debenhams on a long lease have realised that long lease ultimately wasn't very secure. So we've always been careful to ensure that we are invested in assets where that sort of online penetration was going to be manageable. But equally, we've been investing in assets where they are those assets which are very compatible with online, the online channel, and that's why we started investing in retail parks back in 2014.
So, what were the signals when you were thinking about, I guess, what we now call omni-channel stores? What were the signals you picked up on and then took action on that?
Well, we're very focused around trying to utilise high quality research in helping us make sort of the right decisions. And also today now we are, collecting just amazing customer spending data on our assets, and we use that data, I would say, arguably for almost every decision that we would make as an owner and manager of a multi-tenanted retail real estate asset. But our research at the time was indicating that click and collect was going to be the really big growth area of the market, and that has happened. So if you take, for example, Marks and Spencers, who are a big omni-channel retailer. They've got the physical stores and they've got their online channels. About 40 to 45% of their customers that buy online will come to the store to pick up that order. 80 to 85% of returns, because returns is a big factor in the online world, 80 to 85% of returns will be brought back to store by the customer. So what that means is, and this is why the omnichannel retailers are doing better than pure play online and actually taking market share away from pure play online, is they're incentivizing their customers to pay for that journey. It's not really the retailer. So, and that's obviously helpful around protecting the retailer's margins, keeping their costs, down. But they're driving footfall into their stores, because their research also shows that nearly 50% of the customers that come in to pick up an order or return an order will go on and make an incremental purchase at that time, at that visit. So that's driving more revenue into the top line. So it's really good for the sort of P&L.
Well, do you think there's better collaboration now between yourselves as owners and the retailers than there was perhaps in the early years of your career?
Definitely. So, retail real estate's become much more operational. Our leasing events are much more frequent. When I was starting in my career in '88 and into the '90s, typically you'd be, you would be doing leases at sort of 20, 25-year leases with 5-yearly reviews. Leases are much, much shorter now. So I think our weighted average lease expiry profile in our portfolio is about 6 years. I think in the MSCI it's probably about 7.5 years. So you have greater frequency of events coming up. And I think that's also resulted in making sure that you are building relationships with your tenants. That's really, really important. And we've always done that. We've always prided ourselves to make sure that we have very strong relationships with our tenants. Of course, you're going to have sort of competitive tensions at times when you're trying to get the best rent and they're trying to pay the lowest rent. Yeah. But ultimately, our tenants, favor when they have an owner like NewRiver. They know are going to be very active. They know that we're going to be focused around customers. They see that as a positive.
So do you think is there a world in which NewRiver could expand more into the kind of fashion-led centres? Is it a cyclical thing, or do you just think for now it's just off your radar?
Well, I think that the sort of three key physical retail channels is you've got the big destination shopping centres, and those definitely, not all of them, but in the right locations. Those big destination shopping centres will have a sustainable future. They're popular with customers. We know customers go there less frequently, but they do have longer dwell times. And you have to sort of manage those in a different way. But we're not adverse to owning, destination shopping centres. We are managing a few currently on behalf of some investment partners. But selectively, some of those assets will have a strong future, in our view. And then you've got what we call the sort of local community convenience part of the market, where we're predominantly sort of positioned. And again, it's making sure you have the right assets in the right locations. But those type of assets will have a good, sustainable future as well. And we're very comfortable with owning those assets. And then you have the sort of out-of-town retail park format, which is predominantly sort of focused around omni-channel retailing. And our job in terms of the success of our business will be determined by how we get our capital allocation decisions right. So and we have a number of options around that. If we got surplus capital to invest, we've got options, whether that is acquiring assets in the direct real estate market. And we have those three areas that we can focus on, and we've got expertise and experience in all those three areas. And the more choice you have, I think, in terms of your allocation options, then I think you're in a better position to be able to allocate capital into opportunities that are going to give you the best return with the lowest risk profile. And we have that, so we've got those three areas that we can focus on. That's our job, is to make sure that we can, allocate capital as and when we have surplus capital into the right opportunities.
So I guess when you're looking at that market and other investors coming in, do you think there is still sensible decisions being made by others in the retail space? It's like come into favour a bit.
Well, I mean, we don't spend much time thinking about what others are doing. For us, it's about what's right for us, and different investors have different risk tolerance. They have different target returns. So, and that could be a factor that's driving their attitude or where they are in terms of pricing. I think the key around retail real estate is, in terms of around getting the pricing right, you need to understand what is the underlying risk profile that you're buying into. And I think to be able to evaluate risk properly, you need to have high quality data. You need to have real expertise and experience, because retail real estate is a very operational asset class. And you've got to think about not just today, you've got to think about this asset in potentially 5 years' time. Because when you're buying an asset, unless you're buying it in a corporate wrapper, your day one costs are not far off 7%. So theoretically, day one, you're minus 7%. You've lost money day one. Yeah. So you need to own it for a period of time to claw back that day one 7% deficit before you move into positive return territory. And then you've got to own it a bit longer to build up your returns. And so duration is extending out. And with duration, as you guys know, being bankers, risks increase. Longer duration periods carry a higher risk from market conditions sort of changing. So it's really, really important that when you're thinking about acquiring assets, that you've got to think that sort of, what's this asset going to be like in 5 years' time, in 10 years' time? How could the market conditions change within that catchment? Because we've seen how retail has been quite disrupted over the last sort of 15 years from technology.
Yeah.
Of all the commercial real estate sectors, it's probably been the sector that's been most disrupted by technology. And that ultimately has affected the demand for space and markets getting into an imbalance. So, it's really important that, you want to evaluate risk properly, then you can price it properly, And I think we're in a strong position where we feel confident about our ability to do that.
Yeah, for a long time, as you say, for us as lenders, for a long time, retail was tricky because you didn't feel like you had confidence in where the rent level was or where the ERV was.
Yep.
Now it seems to me, from my perspective, that there's a lot more confidence in where that rent level is. Do you think that largely a lot of that kind of over-renting has flowed through the system now in the market you're in?
Yeah, I think it has. I said earlier, I think we feel our marketplace is probably in the best position it's been for 10 years, decade. It starts with the consumer. There's no doubt the consumer has been way more resilient than financial markets had anticipated. Unemployment levels have been low from a historical perspective. I know they're creeping up a bit, but they're still pretty low. Job vacancies have been pretty elevated. So if you wanted a job, you can generally go and get one. Wage growth has been tracking higher than inflation, and that is supportive around rising living standards. House prices have been broadly stable, and that's important because it feeds into consumer confidence. Because most consumers, their net worth is tied up in the value of their house, and if that's going up, people feel better about themselves. And you can see it in the consumer confidence numbers. Consumers' confidence around their personal finances over the next 12 months is strong, and that's been trending up. So they feel confident about their economic position. And then, and you guys will know this more than anyone else, but from what we're getting told, is consumers are sitting on a ton of cash on deposit in, probably a lot of it in your bank. And, that means that consumers are in quite a decent sort of financial position. And this is feeding through to spending. So, spending has been increasing. We have seen year-on-year spending growth. So that we think that's positive for the market, and we think that consumer resilience is likely to continue into this year.
It's an interesting dynamic, isn't it? You mentioned kind of consumer sentiment, and when you look at the surveys, there's often two questions, isn't there? One question is, how do you think the country is doing or the economy is doing? And the attitude is, it's doomed, it's terrible. And then how are you doing? Well, I'm okay, actually.
Yeah.
There's often that kind of, and then as you say, I was looking back at 1988 because of you starting out at that time and end of the kind of Lawson boom years, and at the end of that boom of massive economic growth, unemployment was at, I think, 5.8, which is actually higher than it is today. And you mentioned in your end of year results, earnings growth is growing in real terms. So there's a lot of kind of positive factors that often I think get ignored.
I agree, but we've taken quite a bit of confidence from that, and then that feeds into the occupational markets, because if they're spending money in the shops, that's good for our occupational markets. But again, retail's so high profile that it's written about a lot in the newspapers. It's always on TV. So any retailer that runs into a CVA or administration will be on the 10 o'clock news. It will be all over the newspapers, because the broadcasters and the journalists like to write about it because they know these brands are recognized by their listeners and readers. So it carries a lot of profile, and therefore there has been a view like, death of the high street and all this sort of stuff, and that's all been overdone. We just feel our occupational markets are in a pretty good place. We can see that demand has been improving. Our occupancy in our portfolio has been consistently like 95, 96 sort of percent for good 5 years. We have an incredibly high tenant retention rate, so well over 90% of our tenants choose to remain in our assets, and that's because they're trading well and making profits in our portfolio, which is really positive. But rents have been rebased in the market to a much more sustainable level. Business rates have come down. So like from April this year, notwithstanding our rateable values are rising 7%, but because of the reduction in the uniform business rate for retail, hospitality and leisure for units under $500,000 rateable value, our tenants are going to be paying less business rates in our portfolio. Mine is going down 13%. It's really helpful. And we can see in our occupational cost ratios, when you add in rent, business rates, service charge, insurance premiums, the all-in cost, occupational cost relative to in our portfolio in terms of total sales is just over 8%. It's really, really sustainable. So we're really confident around our underlying occupational markets, and now that's feeding into better confidence in the capital markets. So we're starting to see more liquidity and investor demand flowing through. That definitely started in retail parks about 3 or 4 years ago. We've seen yields compress on the back of that flow of capital for retail parks, but it's now coming through on shopping centres, which is really encouraging. So I think investors are basically saying we have to look at retail because we're all underweight in retail. Other sectors arguably could look quite expensive, and maybe some of the risk profile in other sectors, they're a little bit nervous about. But retail looks, on a relative basis, looks really good value, because the income returns are higher. And the prospects now for rental growth coming through are probably been the best that it's been for quite some time. And so that's what's drawing that investor demand in on the equity side. And you guys on the credit side, I think also are getting more comfortable around retail from a credit risk perspective. So which is also supporting our marketplace. So, and last year, just on the MSCI numbers, retail was top performing sort of subsector. And I think if you talk to most of the sort of analysts, in the real estate market, they would say that retail is probably likely to be top performing sector this year as well.
On a total return basis.
On a total return basis, yeah.
I mean, we as lenders, obviously, we would go for a stable, high yield, stable, predictable sector in a way over one that perhaps is more aggressively priced and higher growth.
Yeah, I mean, so typically on a shopping centre, you've got the benefit of really good diversification through your rental cash flows. We as a business have always placed, importance on having low concentration to any single tenant. So like our policy is never to have one single tenant owning more than 5%. And we've never really been close to that. I think our top tenant today is Boots, probably just over 3%.
It surprised me that the supermarkets weren't a bigger part when I looked at your numbers.
Well, I mean, because over 75% of our assets are anchored by food retailers, but in quite a lot of our assets, the food retailer owns the store.
Right, okay.
Because actual freehold ownership in the supermarkets is still pretty high. Tesco's own a large part of their estate, as does Sainsbury's. So we don't necessarily need to own it, but we just need to be. It's good to be adjacent to it because they are underpinning and driving footfall.
It's interesting. I noticed the other day I was looking at yields from various agencies, yield sheets, and one of them was given the view that your supermarket benchmark yield is basically the same as your retail park benchmark yield, despite the fact that supermarkets typically have, RPI linked or CPI linked leases. Is there a point where you would look at the market and say, okay, we love our retail parks, they've done great for us, but they've re-rated to the point where, you recycle that capital somewhere else?
Well, I mean, we're very disciplined around how we view our assets. So, currently we're updating all of our business plans, which we do on an annual basis. It's a very bottom-up approach, tenant by tenant, and we're reforecasting our views of our assets on, particularly around the rental cash flows. When it comes to the expiry, what's the tenant going to do? What do we think the rent's going to be, etc. All of that gets fed in, and then when we all get our valuations at the end of March, we will plug those numbers in. Then we can recalibrate the forward-looking returns, and we'll look at an asset and go, this is what we're expecting it to deliver. This is the return. Do we think we can get a better return by recycling our capital out of that asset into something new? Do we think that return is compensating us for the risk within that asset? Yep. So that's how we operate, and that will form what we will sell. Because generally every year we would probably sell around about 50 million of assets. This year it's going to be higher. We did 70 million in our first half of the financial year, with a further 40 million that was either under offer or exchange. So we're going to do about 110 million of disposals this year. But that's the right approach. So it's all about returns and risk, and there will be some of our retail parks will get sold because we just think that we can get a better return by reinvesting back into the market, or indeed buying our own shares.
Yep.
And there will be some shopping centre sales, but that's just operating with financial discipline. I'm sure most companies operate like that.
Yeah. So we've talked a lot about today, I guess. We've talked a bit about the disruption that's happening at the moment, online changes. What risks do you see going into the future with, I guess, the continued changes of online and the omni-channel stores?
Well, I think the big thing is AI, isn't it? And I think answering that question is a lot more difficult, and it's something that we are looking at, and it's born out of our experience being in the retail sector, because we've seen how technology can change your marketplace. And that's something that we're looking at, as to how AI and what it could do in terms of accelerating other technological advances. How could that impact the way people shop and live and work and have fun? So we're definitely thinking about that. What's sort of clear to me is, from all the reading and I'm doing and sort of podcasts that I'm watching with people that are in at the forefront of all of this technological change, is the key thing everybody's saying is, look, the change is going to be profound, which I think it is, and it's coming down the line quicker than most people expect. So I think that's definitely going to be the case, and so we are trying to really sort of trying to get a handle on how we think it could impact, both positively and negatively, so that we can get ahead of the curve. But I think in terms of retail, look, it's going to be consumers in the future are going to have way more choice. Everything is going to be way cheaper because of the technological advances. You just think like robotics and everything is all changing. And everything's going to be more personalized. And I think you're going to have a personal concierge on your mobile phone, an AI type agent, and you'll be having a conversation and you'll go something like, this week I really want to lose about 3 pounds of weight, which is what I try and do every week and fail miserably. Can you just make sure that I have a week of healthy meals? And that will be the instruction. And your concierge will know you so well that it will then just go and order healthy meals. And next thing is you've got it all delivered to you, and it will be in your fridge. You can definitely see a lot more of that coming through. And you've got to think through, what does that mean for demand for space and where your assets are positioned. I do think, though, from our perspective in terms of our assets, because we're so local, I do think there will be hyper-local fulfillment one way or the other. So having these strategically important assets in the middle of where tons of people live, we're going to have a lot of optionality around that going forward. Whether that is people still using stores and coming to stores, or that local fulfillment. I think fulfillment is going to be done locally in the future. So
geography and chimney pots remain very
correct.
key.
Yeah.
Thank you very much, Alan. I enjoyed having you
Pleasure.
on today.
Thank you.
He's been Tom, I've been Ashley. That's been another episode of Property Perspectives. Please click like and subscribe.